Today's episode is brought to you by Forvis Mazars.
Sound Cartel.
From Sound Cartel, I'm Nicole Goodman, and this is Business Essentials Daily. A new financial year is almost upon us, and that means getting ready for payroll tax returns. Not the most exciting subject, but if you don't get it right, you could be in a world of hurt. And getting it right can be tough, especially if you have staff located nationally and under different state rules. To walk us through the payroll maze is Steve Baxter, National Indirect Tax Partner at Forvis Mazars. He begins by reminding Chris Ashmore how payroll tax works.
Payroll tax is payable by applying the payroll tax rate to the total employee wages above a payroll tax-free threshold. These vary across the nations, with rates ranging from 1.21% to 6.85% and tax-free thresholds ranging from $700,000 to $2 million. It should be noted that the payroll tax-free threshold system is designed to keep very small businesses out of payroll tax. Businesses with employees in only one state and with total wages only just above the thresholds will usually lodge just one return and make just one payroll tax payment per year. In some states, there are 6 monthly returns and payments. However, many businesses will have to lodge monthly returns with payments for each of the first 11 months of the year, and then an annual return which covers June wages plus any other wages not reported in the first 11 months. The annual return calculates the total liability for the whole year, but the amount payable with that return is the total annual liability less the amounts already paid over the previous 11 months.
And when are payroll tax returns due?
Well, this is another one of the complexities. Because of where the weekend falls this year, returns are due by 22nd of July in Victoria, Queensland, WA, Tasmania and Northern Territory, and returns are due by the 29th of July in New South Wales, ACT and South Australia. If you employ in more than one state, the reality is you have to prepare all the return calculations together.
Why is that? Why do you have to prepare them together?
That is so that the tax-free threshold can be apportioned between the states. To give an example of how it works, let's say in a 2024 financial year, half your national wages bill is for employees in Victoria and the other half is for employees in other states. In that case, the normal Victorian payroll tax-free threshold is halved from $700,000 to $350,000, and Victorian payroll tax will be payable on Victorian wages above $350,000. And a similar apportionment happens in all the other states. This has the effect that the amount of wages in one state will affect the amount of payroll tax in another. Taking the example above, if you find an error that meant wages were in fact lower in Victoria than the rest of the nation, then the Victorian tax-free threshold will be lowered and the other states would have their thresholds increase, and the tax calculations in each state are likely to change. It also needs to be remembered that if you only employ in a state for part of the year, you only get part of the tax-free threshold. To avoid having to repeat the calculations and return preparation across the states, best practice is to start well before the first return is due to correctly determine total wages paid in all states and then prepare the returns.
For the purpose of payroll tax, what are wages?
Wages will typically include payments made through the payroll system, such as ordinary wages, leave payments, bonuses and super. These are payments that typically get captured correctly in the monthly or 6 monthly returns lodged during the year. However, wages for payroll tax can include a series of payments that are not processed through payroll systems. These can include things like fringe benefits, shares issued and options granted to employees, directors' fees and contractors who can qualify as employees for payroll tax purposes. The annual return process is the ideal time to review these categories of benefits and payments to determine if payroll tax is payable on them. And that can mean making inquiries outside of the employer's usual payroll and HR functions to the business units itself or to management.
If a business hasn't paid payroll tax on these payments during the year and it turns out that they should have, is it in trouble?
Look, provided it correctly identifies them and reports the annual totals in its annual return, there are usually no repercussions. The revenue authorities recognise that many businesses can only properly examine some payroll categories annually, and further, they recognise that some payment types are only made once a year in June, for example, bonuses. Of course, the net amount payable in the annual return should total the wages paid in June alone. If a revenue authority saw a repeated pattern whereby the annual return payment significantly exceeded the average for the previous 11 months, the employer is more likely to be an audit target.
Any issues that employers need to take care with when they prepare their payroll tax calculations?
Yes, there are quite a few. The first issue is to identify any entities that they should be grouped with. A payroll tax group only gets one tax-free threshold. In New South Wales, for example, the loss of one payroll tax-free threshold when two related entities form a group can cost up to $65,000 per annum. Grouping is a complex topic. Family groups, partnerships and entrepreneurs need to look at all the businesses that they control which have employees. Things to look for include directorships, businesses operated by the beneficiaries of a trust, and where employees work in more than one business. Any of these could persuade a revenue authority to group entities and put one or more payroll tax-free thresholds at risk. The second main issue is to identify any contractors who can be treated as employees upon whom payroll tax is payable in some cases.
All those items are added to your payroll tax bill. What about things that might reduce it?
One thing to look for is payment types where part might be taxable and part might be exempt. Termination payments and parental leave payments are two examples. Another issue is to identify employees who work in more than one state over the year or who work outside Australia. The outcome could determine which states the wages are allocated to or whether some part of the wages is exempt. For example, a Queensland employer might have one employee who is based in Auckland for 8 months in a year and another based in Melbourne, having moved there for the final 6 months of the year. The wages subject to Queensland payroll tax should exclude the exempt wages while the first employee was in Auckland and the 6 months of wages for the second employee based in Melbourne. However, they could, of course, be subject to Victorian payroll tax. And finally, the annual return is often the best time to check if any of the minor payroll tax exemptions and concessions are available. Each state has them, and over the years they've included things such as businesses based in rural or low-income areas, apprenticeships, emergency services leave, and special concessions for employing Indigenous persons or those with disabilities. There are too many of these to list here, but it's worth checking at annual return time whether any might apply.
And I understand there are also surcharges or higher rates on top of payroll tax.
Yes, several of the states have high rates. For example, the payroll tax rate increases in Tasmania, South Australia and Queensland for wages above certain thresholds. Victoria imposes a mental health and wellbeing surcharge and a COVID-19 debt temporary payroll tax surcharge. Combined, the extra amount the employer will pay is 1% of the Victorian taxable wages over 10 million and 2% of the Victorian taxable wages over 100 million. Queensland also imposes a mental health levy. The levy rates in Queensland are lower than those in Victoria. They apply to Queensland taxable wages where an employer has annual Australian taxable wages which exceed the 10 million and 100 million thresholds, with the rates being 0.25% and 0.75% respectively.
Have there been any significant payroll tax changes that need to be considered?
Yes, but they are largely industry sector or state-based. A series of court cases and subsequent rulings have significantly affected the medical centre and mortgage broking sectors. Further, the courts have decided that many services businesses have payroll tax liabilities as employment agents because they, in effect, provide workers for their clients' businesses. But looking ahead, Victoria has lifted its payroll tax-free threshold to $900,000 from 1 July 24, and that will be further lifted to $1 million from 1 July 25.
That was Steve Baxter, National Indirect Tax Partner at Forvis Mazars. Business Essentials Daily is a Sound Cartel podcast. Producers are Nick Schildberger, Chris Ashmore, Jeff Waters and myself. Technical production by Pete Letts. I'm Nicole Goodman. Thanks for listening. We'll bring you more B Daily next week.
Sound Cartel.
This episode was brought to you by Forvis Mazars. To find out more, visit forvismazars.com/au. That's FORVISMAZARS.com/au.